While America sleeps, a subtle shift takes place in millions of bank accounts. A change so quiet most will never notice it until they look. If you aren't watching closely, you could completely overlook what just occurred. The first Social Security payments for 2026 have begun to land, and for a huge number of retirees, the figures appearing in their accounts now aren't identical to last month's deposit. A few are larger, others have shifted in less obvious manners. And for many, this prompts a crucial question every person relying on this income should consider. Do I truly grasp what I'm getting and the reasons behind it? Have you ever glanced at your bank statement and felt that flicker of doubt, that silent worry questioning if the number is right? You are in good company. For more than 10 years, my work has been focused on helping retirees navigate their finances, safeguard the nest eggs they spent decades building, and approach life after 60 with greater assurance. I'm not offering a product or trying to confuse you with jargon. I'm here because these moments of transition are significant, and having clear information can profoundly impact your sense of security. For countless individuals, this program isn't merely a government benefit. It's the bedrock of their financial stability. So when it evolves, even silently, it warrants a closer look. What sets 2026 apart isn't solely the fact that deposits are rising. It's the timing of these adjustments and the method by which they're implemented. The economic landscape for seniors has transformed dramatically in recent years. A trip to the supermarket costs more. Medications take a bigger bite from the budget. Housing expenses for owners and renters alike demand more every month. When you live on a fixed amount of money, every tweak to that number, no matter how minor it appears in print, has tangible consequences. The system is built to adapt to these realities, but its inner workings are rarely transparent or thoroughly communicated. Updates are computed behind the scenes, enacted automatically, and seldom explored with the detail that retirees need. This is why one person might see a bigger deposit and feel a wave of relief, while another feels baffled or even alarmed when their payment doesn't align with their calculations. The reality is this: these modifications aren't arbitrary gifts. They are outputs of established equations that react to the broader economy, inflation, and each person's unique earnings history. But here's a critical detail that frequently escapes notice. Two individuals retiring at the same time, even in the same community, can see divergent outcomes when these yearly updates are applied. Without a fundamental grasp of the process, it's simple to suspect an error when in fact the machinery is operating precisely as intended. This makes timing a key piece of the puzzle, because these payments don't just show up at random. They adhere to a strict calendar that many folks were never clearly taught. Your birth date largely dictates your payment schedule, assigning your deposit to a specific Wednesday each month. Earlier birthdays typically mean earlier payments. Later birthdays mean your funds arrive later in the cycle. And then, there are the exceptions that alter the schedule for particular groups. People who started collecting benefits before the late 1990s, or those who get extra aid alongside their retirement check, often follow a completely different timetable. Mix in weekends and national holidays, and it's no wonder someone might check their balance on the incorrect day and experience a jolt of unnecessary fear. Knowing this schedule isn't just about marking your calendar. It's about knowing when to stay calm, when to be patient, and when it might be time to make an inquiry. In an era where each dollar is vital and anxiety is already high, that knowledge alone can provide a layer of comfort. As we go forward, my aim is for you to feel anchored, knowledgeable, and at ease. Because the more you comprehend these under-the-radar adjustments, the more empowered you'll be to safeguard your earned benefits and utilize them fully. Now, let's examine the element everyone sees first, the actual sum that lands in your account. This is where the 2026 adjustment becomes concrete. Payments have been modified this year to reflect higher costs for essentials, a change known as a cost of living adjustment, or COLA. Simply put, it's intended to help your buying power tread water when prices rise. For 2026, that COLA is 2.5%. On its own, that percentage might seem modest, even insignificant. But when you break it down over the course of a year, the picture changes. If your monthly benefit was about $2,000 last year, This increase adds approximately $50 each month. Across a full year, that's an extra $600. For married couples, that annual figure can be double. That additional cash could translate to a fuller grocery cart, an easier time paying for a doctor's visit, or simply a bit of slack in a tight monthly plan. For many, that tangible difference outweighs any statistic. It's vital to know this raise was applied for you. You didn't need to apply, and no forms were required. That's why some individuals open their banking app to find a slightly larger deposit without any prior notice. It seems abrupt, maybe even startling, but it's neither a gift nor an error. It's a built-in response to economic conditions. Simultaneously, this is where bewilderment often begins, because not every increase is identical, and not every net deposit meets expectations. You might hear a friend mention a noticeable jump in their check while yours seems less than you anticipated. That doesn't indicate a mistake. It usually signals your personal circumstances are distinct. Your benefit is constructed on your individual career earnings, not a universal sum handed to everyone. The formula examines your highest paid years, updates those figures for inflation, then applies a calculation that offers more substantial support to those with lower lifetime income. This is by design. The outcome is that two retirees can both get a 2.5% boost, but the actual dollar increase can vary widely. Furthermore, many people have automatic deductions that change the final deposited amount. The most prevalent is Medicare Part B. For this year, those premiums have risen, and for numerous seniors, they are taken directly from the Social Security payment. This means your total benefit might be higher, but the amount you see deposited could be less than you calculated. This is aggravating if nobody clarifies it for you, and unfortunately, many never receive that clarification. This leads to a principle worth stating with kindness and directness. Comparing your payment to another person's rarely brings comfort. It usually sows doubt or concern where none should exist. Your benefit mirrors your history, your decisions, and your timing. It is not a measure of your value or your lifetime of work. Internalizing that can remove a quiet weight many people bear unconsciously. And if something genuinely appears incorrect, there are steps to check, which we'll cover soon. But first, there's another reason your deposit might appear altered this year, one that often slips under the radar. Beyond standard retirement checks, additional support exists for some seniors who meet specific criteria, often without their knowledge. Supplemental payments are meant to assist those with very low income and minimal assets in covering basic needs like food and shelter. For eligible individuals, this can be a crucial lifeline, but qualification hinges on strict limits for income and resources, and the guidelines can be difficult to parse. Additionally, some states contribute their own extra assistance while others do not. This implies your geographic location can directly affect your total monthly support. Two retirees in similar financial straits can end up with different total incomes solely because they reside in different states. This nuance isn't common knowledge, and many assume the system operates uniformly nationwide. It does not. Here's the most critical part. These extra benefits are frequently not automatic. In many situations, you must submit an application and provide correct details to receive them. If you're never informed, it's easy to miss assistance specifically established for people in your position. Grasping all of this isn't about earning a degree in policy. It's about cultivating awareness. When you know adjustments occur, deductions impact the bottom line, and extra benefits might be available, you are far less prone to confusion or alarm when your deposit changes. And that's precisely where you should be. Calm, informed, and confident enough to assess if what you're receiving aligns with your situation. Because while this system is vast and designed for fairness, it depends on individuals to stay aware and proactive. As these 2026 payments continue to be distributed, pausing to understand why your amount looks the way it does can shield you from needless stress and help guarantee you're getting all you qualify for under current rules. There is another domain where retirees are often astonished to learn they might qualify for more than they currently get. And this area can feel private, as it's connected to marriage and loss. Spousal and survivor benefits were established to acknowledge that retirement is frequently a shared path. If you're married and your partner earned considerably more over their career, you may be eligible for a benefit based on their record that exceeds your own. This doesn't diminish your spouse's payment. It simply permits you to receive up to 50% of what they'd get at their full retirement age. Yet countless people never file for this, assuming it happens automatically or doesn't pertain to them. Survivor benefits are even more commonly missed. If your husband or wife has passed away and they were collecting Social Security, you might be eligible to step into their full benefit amount if it's greater than yours. For those who have lost a partner, this can mean a major boost in monthly funds at a time when finances often feel most vulnerable. But again, this transition isn't typically automatic. It usually requires an application, proper paperwork, and clear dialogue with the administration. Then there are benefits for divorced spouses, a provision that silently supports many who would otherwise face hardship. If your marriage lasted a decade or more and you are not currently remarried, you could claim benefits based on your former spouse's earnings history. This holds true even if they have remarried, and it doesn't reduce what they or their current spouse receives. Many feel hesitant here due to discomfort or uncertainty, but it's important to recognize this benefit is established in law. It's not a special request, and it isn't taking from another person. It acknowledges the years you built a life together and the financial partnership that entailed. When these benefits are missed, the loss isn't just monetary, it's a missed opportunity for security. Too often people discover them far too late, after significant sums have gone unclaimed. Knowing what you might be eligible for logically leads to the next step, ensuring what you receive is correct and protected. One of the easiest yet most potent tools at your disposal is your official online Social Security account. This portal lets you review your payment history, current benefit rate, and any adjustments that have been made. It confirms payment dates and shows the math behind them. If you've never created one, that's understandable. Many seniors weren't introduced to digital tools when this system launched, but today, accessing this information offers clarity and a measure of control. It helps you identify discrepancies early, before they become months of missing income or difficult phone calls. It also allows you to verify your bank details are current. One of the top reasons payments are late or misrouted is simply outdated account information. Switching banks or closing an old account without notifying Social Security can quietly interrupt your income stream. Your financial institution does not update this for you. That duty falls to you. If a payment seems late, knowing whether to wait or to contact someone can prevent significant worry. Sometimes it's a calendar issue. Other times, a simple update fixes everything. The crucial point is to not ignore that feeling of uncertainty. Staying involved, even in minor ways, protects the income you rely on and bolsters a feeling every retiree is entitled to. Confidence that what you labored for is being managed properly. There are also quiet reductions that surprise many, not due to any error on their part, but because the rules were never plainly explained. A very common one involves earning wages while receiving benefits before reaching your full retirement age. Many seniors choose to work part-time or take on occasional jobs, which can be a positive and fulfilling decision. But if you're under the full retirement age for the entire year, an earnings limit applies. For 2026, that threshold is just above $23,000. If your income surpasses that, the administration will temporarily withhold a part of your benefits. This can be a shock if you're unprepared, particularly when a deposit is smaller or absent. What's key to understand is this isn't a fine, and it's not forever. Once you hit full retirement age, those withheld amounts are factored back into your monthly payment, effectively increasing it later. The system is adjusting for timing, not permanently removing funds. Still, if you depend on that monthly cash flow for essentials, even a temporary dip can create strain. Knowing these limits in advance lets you plan your work and income with fewer surprises. Another area that needs gentle, straightforward attention is taxation. Many retirees are genuinely taken aback to learn Social Security income can be taxed. Whether it is depends on what the IRS terms your combined income, which includes half of your benefits plus other income like pensions, investments, or withdrawals from retirement savings. If this combined total passes specific limits, a portion of your benefit may become subject to federal income tax. For some, up to half. For others, up to 85%. This doesn't mean 85% is withheld. It means that percentage is considered taxable income. The difference is important, but rarely explained well. When taxes aren't anticipated, they often arrive as a stressful surprise at tax time, straining an already limited budget. An option many don't realize exists is requesting voluntary federal tax withholding directly from your monthly payment. By choosing to have a small percentage held back each month, you can spread the tax burden across the year instead of confronting one large bill. This isn't suitable for everyone, and it merits discussion within your overall financial plan. The core lesson is awareness. When you understand how work income and taxes interact with your benefits, you regain a sense of command, and that command fosters confidence, which is as valuable as the money itself. All this culminates in one of the most significant choices you'll make regarding Social Security: when to start. You can begin as early as age 62, and many do. Others wait until their full retirement age, and some delay further, up to 70. Each path carries long-term implications, and none are universally correct or incorrect. Starting early means you get checks sooner, but each is permanently reduced. Waiting results in larger monthly payments, but you'll receive them for fewer years. The arithmetic often highlights a break-even point, the age at which waiting pays off if you live long enough. But life doesn't always follow a spreadsheet. Health, family history, current savings, and personal peace of mind all play a role. Someone in robust health with long-lived relatives might gain significantly from delaying. Someone with health concerns or immediate financial pressure might find starting earlier is the wiser path. What troubles me most is when people claim early purely out of fear or confusion, not from thoughtful consideration. Decisions rooted in anxiety seldom bring tranquility. Delaying benefits past your full retirement age increases your monthly amount by roughly 8% for each year you wait, up to age 70. After that, there's no further advantage to waiting. For those who can manage the delay, this increase can offer important security later in life, especially as medical expenses tend to grow with age. But postponing isn't always feasible or practical. The essential thing is that the choice is made consciously. You deserve to comprehend the trade-offs, to measure them against your own life and priorities, and to select what aligns with your needs. This program was never intended as a uniform solution. It's a base layer. How you build upon it depends on your unique story. When you approach these decisions with clarity rather than pressure, you're much more likely to feel content with the road you take. As we wrap up, I'd like you to take a quiet breath. If any of this felt new or somewhat heavy, that's perfectly normal. Social Security was never clearly taught to most, yet it influences nearly every aspect of life after 60. What's important isn't memorizing every regulation or figure. What's important is that you now hold a key insight. Changes don't simply occur to you. When you're informed, you can anticipate them, interpret them accurately, and react with assurance instead of anxiety. The subtle increases rolling out in 2026 are more than a few extra dollars. They're a signal that this complex system was ultimately designed to sustain you, and that comprehending it is a powerful act of self-protection. You labored for these benefits. You built plans around them. You have a right to feel secure, understanding how they function and how to ensure you're receiving all you've earned. If this conversation helped you feel more settled and self-assured, then I've achieved my purpose: to swap uncertainty for insight and replace worry with a sense of calm. If you found value here, would you consider giving this video a like? It truly helps my channel reach others who need this clarity. And if you know another retiree who feels perplexed by these yearly changes or worries about their Social Security, please share this with them. Sometimes a single clear explanation can lift a burden that's been carried for months.